Home Depot stock just released their Q2 earnings report, and we can see a huge jump in the share price over the past few days, up over 10% year to date. If we come here, we can see they did beat all their expectations. Scroll down a little bit further, we'll see their earnings per share was $5.05 versus the $4.94 expected, and the revenue $43.79 billion versus the $43.36 billion expected. So great beat on the earnings report. Now, from a dividend investor perspective, this is a stock you absolutely have to love. If we come over here and look at the dividend history on Seeking Alpha, we'll scroll down just a little bit, and once this chart loads in, we're going to click on max right here, and this is what you absolutely love to see. This is massive dividend growth that we're seeing over time from this company. So in this video, let's go ahead and jump into my stock valuation spreadsheet to see if this is a company we should be buying or selling. On this spreadsheet, we have our 4 valuation models. We have Graham's valuation, we have a discounted cash flow model, we have a multiples valuation, and a dividend discount model, and all 4 of these valuations will roll into our output tabs. Let's go ahead and jump over to our stock screener. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in the stock ticker for Home Depot and click enter. And we can see all of this data is going to automatically load in. And we're currently looking at a 500-day change. Let's go ahead and zoom in just a little bit more. Let's say we want to look at a 300-day change and hit enter, and we can see the run up in the share price over the past couple of months. Come over here and look at the dividend data. We can see they're paying out $7.60 per share, and the dividend yield is currently sitting at 2.32% with a payout ratio of 43%. Now, that's not a super high dividend yield, but we're going to look at the dividend growth a little bit later, which is one of the reasons I love this company so much. Now, 20 and 50-day moving averages are both positive now, and the 200-day moving average down slightly. Currently trading at a price of $327 per share. Analysts currently have a target price of close to $351 per share. Now, this company has a beta of 0.99, so typically this is going to be a company where the volatility levels follows pretty closely to the market. But let's go ahead and look at Graham's valuation, and this is a valuation model invented by Benjamin Graham. And this is the formula he laid out for us in his book, The Intelligent Investor, to calculate intrinsic value. So what we're going to do is we're going to plug in the earnings per share for Home Depot, which is automatically pulled in with this spreadsheet. We're then going to put in 7 for the price to earnings of a company with no growth and apply our growth rate projection. Analysts are still projecting a pretty high growth rate for this company, despite a potential, not necessarily a economic downturn with the housing market, but maybe a slight drawback. We then plug in the average yield of AAA corporate bonds, which is 4.4, and we divide all of that by Y, which is the current yield on AAA corporate bonds. And at the time of this video, that's sitting at 3.96. And once we plug all of this together, we come to an intrinsic value of $367 per share. But let's go ahead and look at our discounted cash flow model. And in order to perform a discounted cash flow analysis, we need to project a growth rate for the future free cash flows for the company. So what I've done is I plugged in the historical free cash flows here, so we can see year over year the growth rates for this free cash flow. We can see it had an average growth rate of right at about 6.6%. Now, moving forward, I am projecting a growth rate of about 12%. It's a little bit more on the conservative side, but I think it's going to be pretty close to what it'll actually be after looking at analyst expectation, industry expectations, and just expectations for the company as a whole. So I applied that growth rate to the future free cash flows and applied it to the terminal value, which is the sum of the future free cash flows past the year 2030. I then used it to project the present value of these future free cash flows and added them all together here, added the company's cash and cash equivalents, and subtracted their total debt to come to their equity value. After I got their equity value, I divided by the number of shares outstanding to come to a discounted cash flow price per share of $415. Now let's go ahead and move on to our multiples valuation. And I think we do have some good comparables for Home Depot, so this is going to turn out to be a pretty good valuation. We're taking companies like Lowe's, FND, LESL. We're taking the stock price and dividing by the earnings per share to find their price to earnings multiple. Once we have their price to earnings multiple, we take the average and multiply it by Home Depot's earnings per share to come to our intrinsic value. So essentially what this valuation model is doing is it's looking how the market is valuing companies that are similar in structure to Home Depot and seeing what their price to earnings multiple is, which is it's essentially a way to see how the market is valuing these other companies. And so this is a little bit of a lower valuation using the multiples valuation. So if we look at the average price to earnings of these companies that are similar to Home Depot, if we jump back over to the stock screener, we can see Home Depot does have a slightly lower price to earnings at 20.78. But let's go ahead and jump over to our dividend discount model now. And now this is the valuation model I absolutely love for companies like Home Depot and Lowe's because we've seen so much dividend growth from them historically speaking. But the idea behind the dividend discount models, we should be able to value a company based on how much they pay out in dividends and how much that dividend is increasing. So I plugged in the past few years dividend payouts quarterly, so we can see how much they pay out each year. And this allows me to see the year-over-year growth rate. So we can see a huge jump in the dividend payouts right here, 32%, a year with 10%, another 10%, and then a 15%. So really good dividend growth over the past few years. And like we saw earlier on our chart, they do have quite the history of increasing the amount they pay out in dividends. But we can see that's an average growth rate of right at 16.8%. So I'm projecting a growth rate of about 7% moving forward. Now that actually is pretty high when you consider that's a growth rate projecting all the way out to the future. Now, after applying a discount rate of 9%, we come to a dividend discount model price per share of $406. So let's go ahead and jump over to our output tab. And here on the output tab, we have all four of our valuations. Grams at 367, multiples at 331, discounted cash flow at 415, and dividend discount model at 406. Now, when we average all four of these together, we come to an intrinsic value of $380 per share. Now, the current price of this company is $327 per share. Now, so the intrinsic value is a bit higher than the current price, but as a value dividend investor, we do always want to apply a margin of safety. So if you're more aggressive, maybe you apply a 10% margin of safety, you can see your acceptable buy price would be $342 per share. So our spreadsheet is telling us this is a stock we should be buying. If you're a little bit more conservative, let's say you apply a larger margin of safety at 30%, you can see your acceptable buy price would be about $266.17 per share. So our valuation is telling us this is not a stock we should be buying. If we jump back over to Seeking Alpha, let's go ahead and look at that chart again. Now, obviously they're trading at $327 a share right now, but not so long ago, if we look at our year-to-date chart, we can see they were trading as low as around $276, $268 per share. So there have been really good opportunities to buy this company at a great price. I think even with a jump in the share price, there may still be opportunities in the future to go ahead and buy this company. If you have a really long time horizon with your investing, this is a really great dividend growth company to consider investing in. I'm looking at adding shares into this company and potentially Lowe's. I already own some shares of Lowe's. I'll likely make a stock analysis on them soon. But like I said, if you have a long time horizon, the dividend growth you're going to see from this company is pretty phenomenal. I would like to see the share price go back down a little bit for selfish reasons. I love buying great companies at lower prices, but I'm not surprised by the huge run up in the share price over the past couple of months. But go ahead and let me know what your thoughts are on this company in the comments down below. If you plan on buying or selling, if you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching the video, and please don't forget to like and subscribe to the channel.